Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be discussing how to profit more consistently when using swing trading strategies, the All Ordinaries Index and this week's Stocks of Interest. Now if you're a regular to this channel, welcome back, and if you're joining us for the first time, let me extend a big welcome, as you will no doubt gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any thoughts on this week's report, or you just have a question to ask, please comment below and be sure to subscribe to our channel so you keep up to date. Also, click the like button just below right now. So let's get into this week's report. When trading the stock market, the most important priority for traders is entering or exiting a trade at the earliest possible time and at the lowest possible risk. This means buying a stock when it indicates with the highest probability that it will move up in a continued uptrend, or selling when it indicates it will fall away in a continued downtrend. Now, while this is great in theory, how do you put this into practice? Now, that's where incorporating swing trading strategies into your trading will give you the greatest advantage. Let me ask you, do you find you continually get stopped out of trades, or you have a series of low profitable trades followed by a big loss? You may even get a series of small losses and an occasional good profit. If that is you, then let me say you're placing trades that have a lower probability of success. But don't worry, you're not alone. The majority of traders who come to me to fix their trading are exactly the same. You don't know what is wrong with your trading until you get a great mentor who finds all those little issues that are stopping you from making real money. Now, I find that many traders continually chase profits with little, or in some cases no, regard for what they can lose. And as a result, they take higher risk than necessary to achieve their goals. Now, the end result is that over the long term, their portfolio either underperforms or they lose. Now, that can all be fixed. So how do you increase your probability of success? Well, firstly, you need to understand that good trading is not about getting in at the absolute lowest price and out at the absolute highest price. Attempting to do this is not only hard to do, but it increases your risk and reduces your returns. Now, there are many things you can do to increase profit and reduce your losses. The first is to increase your knowledge, as poor performance is a sign of a lack of knowledge. You can also set better, more consistent money management rules. You can also work on your trading psychology, as many traders underestimate the importance of this area. You could also use a trading plan, as I know with high probability that if you are not consistently profitable or are struggling in your trading, that you are not using one now. And the list of things you can do just goes on. Now, while these areas may seem like common sense, I must admit that I've met literally thousands of people who tell me that they are traders but have little or no concept of these areas, particularly when it comes to a written trading plan. Now, why is this? Well, they live under the illusion that they do understand them. Yet I cannot fathom how anyone could think they will be a successful trader without having a written trading plan. That's like trekking through the wilderness without a compass, food or water. Crazy, right? Well, to help you in this market report, I will introduce you to a simple technique that you can include in your trading plan. Now, it takes very little time and it will significantly increase your probability of success. Now, when I mean significantly, I mean tens of thousands of dollars in extra profits and significantly fewer losses. So what is this simple technique? Well, it's one of my favorite trading tools, the Gann swing chart. You know that 90% of traders are not consistently profitable, and these traders do not know what Gann swing charts are, and so you know these are a key to profitability. For those of you who are not familiar with Gann swing charts, they are a price-based chart constructed from the price relationship between bars on a bar chart. The basic theory is that the swing chart swings up in price if the current bar has a higher high than the previous bar, or swings down in price if the current bar has a lower low than the previous bar. Now, an important point to note is that in general, swing charts have no relevance to time. Instead, they provide a very visual representation of the direction and strength of the market. At any one point in time, depending on what the price of the stock is doing, the swing chart will either be pointing up or down. When trading for profit, it is important for a trader to know the direction of a stock over the short, medium and long term every time they trade, and here is the key to why most struggle and fail. The time frame you are trading will determine how you view a swing chart and how you apply your swing trading strategies. And here is the key to your success, in that you not only need to learn about these charts properly, but learn how to apply the analysis to them correctly. Now let's look at an example. Let's say you want to trade over the medium term. Now, as you can see on the screen right now, I have included a weekly bar chart on the left of the screen, together with a weekly and monthly swing chart. Notice on the bar chart the stock has two bars clearly trading above the downtrend line, which would normally signal an opportunity to buy. If you look at the weekly swing chart on the very right of the image, you will notice that it is pointing up, which is also consistent with a good buying opportunity. But if you look at the monthly swing chart in the middle, you will see that it is pointing down, which indicates the larger price movement is down. In trading, you need to assume that the short-term trend will always conform to the longer-term trend. Therefore, given that the monthly swing chart is pointing down, you need to assume with high probability that the weekly swing chart will conform to the longer-term trend. So until the swing chart indicates otherwise, you would not enter a trade. Again, we are attempting to pick the safest time to enter, not just any time. Knowing buy and sell rules alone will never make you consistently profitable. Now back to the example. Eventually, when the stock is strong, both the weekly and monthly swing charts will conform. And when they do, you will be able to enter the stock knowing with high probability that it will continue to move up over the medium term. When they do conform with each other, you will find that you make more consistent profits. In this example, the price at which both monthly and weekly charts should conform is $2.88, which is indicated by the horizontal line on the bar chart. This is the point that will result in the monthly swing chart turning up. Let me share you with a number of rules I recommend you include in your trading plan when using swing trading strategies. When trading short term, over several days, both the daily and weekly swing charts should both be pointing in the direction of the trade that you want to take. So if you trade forex, options, warrants, or contracts for difference, then unless you are totally proficient in cycles theory and time analysis, I recommend you rigidly stick to this rule, as it will help you avoid many losses and keep your money safer. If you trade over the medium to longer term, then both the weekly and monthly swing charts must be pointing in the direction you want to trade. Break these rules and it will greatly increase your risk, increase your losses, and decrease your profits. For many, sticking to the rules will be hard, as you may find a stock moves in the direction you want, but the swing chart keeps you out of the trade, and this may result in you entering at a higher price. While at times this may be the case, let me say that you need to have faith in the rules, because I promise you that it will save you from entering losing trades and increase your overall trading returns. Now, let's look at other ways that swing charts can support you in your trading. Swing charts only represent price movement of a stock. They filter out the noise that is commonly associated with bar charts. Therefore, swing charts just make it easy to see things like peaks or troughs, support and resistance levels, chart patterns, and in determining the strength of a stock. On the weekly swing chart on your screen right now, I've shown 6 years of price history. Now, I could have easily included 10 years on the chart and it would still be very easy to read. I've marked some horizontal lines on the chart indicating both the support and resistance levels, as well as marking where the stock retraced 50% of the last up range. The uptrend started from the low in March 2014, after which the stock confirmed successively higher swing lows and highs. Now, this indicated that it was now in an uptrend. In October 2014, the stock turned down in price to test support before turning back up. Given that the stock retraced less than 50% of the last upswing in price, it confirmed the stock was strong. From there, the stock moved up in price to break up through the downtrend line to confirm a nice, safe buying signal. In fact, this is one of the lowest risk trades you can take. Given that the stock had closed twice above a downtrend line, both the monthly and weekly swing charts were pointing up. The stock had also confirmed a higher swing low and high on a weekly swing chart, and it had retraced less than 50% of the last range. It seriously does not get much better than that. So here's a tip for new traders. Every single swing high and swing low on a swing chart can be used to apply a trend line. Therefore, if you're ever in doubt about whether you can draw a valid trend line on a bar chart, simply look at the swing chart to see if there are 3 swing highs or lows that you can connect. Now, to increase your knowledge in using swing charts, I recommend you look at several stocks and notice how various patterns unfold, including things like head and shoulders, flags, pennants, double tops, double bottoms, and how easy they are to spot. I also recommend you apply various tools to your swing charts like trend lines, price extensions and retracements, as well as other popular tools just to see what happens. Now, if you're like me, you'll be amazed at how easy it is to analyze a stock using this type of chart. You'll also be amazed at how much your trading improves. So let's get into this week's stocks. All right, guys, just looking at your screen right now, you can see the All Ordinaries Index on the screen. I've just got a chart that I've been using with some of our students, and you can see a few different things on it. But right now, the All Ords is doing exactly what I'd had hoped to do last month. It's now doing it this month, and it is increasingly looking like I was just a month out in my timing of that. And that happens sometimes because the market's never 100% black and white. It is an emotional thing that, your best laid analysis sometimes doesn't work out, and sometimes it happens a bit earlier, sometimes it happens a bit later, but that's what makes the market quite exciting. And right now I think the market is moving up strongly. This is a monthly chart you're seeing on the screen right now. I just wanted to show you the monthly chart to see how strong it is. I mean, it opened at 5709, currently closing at 5941. So we've gone up over 200 points so far this month. Now let's look at the chart that I was using last week, and you can see here how the last week it's been moving up quite nicely since that low, which was the 20th of December, or that week of the 20th of December. So we've been moving up really, really nicely since then. As you can see, last week opened at 5834, closed at 5941, which I just mentioned. 2 beautiful strong weeks up. We may get another week up at this point in time because we've had 3 weeks up. We may get that level there, 5979. It'll be interesting to see if it breaks that this week. But I would be expecting a week down over the coming couple of weeks. We may get 1 or 2 more weeks up and then 1 week down. But I think if it's going to have a week down, it might be somewhere around here. But we could get up to that 6,100 point level where my pointer is at this point in time. But it is looking, again, it is looking quite strong, our market, and I do still think that we'll be moving up through this first quarter of this year, and it's auguring really, really well, and probably even moving up most of this year. They always say, there's an old saying that if January's really good, the market's really good for the whole year. So right now, January is looking really strong and really good. It's still a little bit too early on some of the stocks, like the bank stocks. The jury's still out on them. I do think the bank stocks will be bullish this year, like I mentioned in my last report, but way too early to buy them now. It's something you should be sitting back and waiting till the Royal Commission does its announcements, which I think is due the 1st of February. So bank stocks, hang off till after the 1st of February, because there's something in those bank stocks or in that Royal Commission report. It could see those bank stocks fall back to 8 or 10%, which may be the catalyst of our market having that week down that I talked about, because the bank stocks are a very, very heavy proportion of our index, or the actual financial sector is. So therefore, when the Royal Commission report does come out, you may see that, because that's only 2 weeks away. So we may see 1 or 2 weeks up, and then the announcement comes back, and then we have 1 or 2 weeks down, and the banks may fall. So you'll get a better opportunity to buy them after the 1st of February. That's what I think. It may not happen in terms of the bank stocks, but I think you might be better off there. Today I wanted to talk about a couple of things. I just want to grab my piece of paper because I had some stocks all keyed up last week that a couple of our viewers actually asked me to have a look at. I'll just bring them up, and thanks to those viewers for bringing up those stocks. for us to review last week, and I actually did have them, but then I went on to the banks and forgot about you, so I do apologise for that. So Benny Boy asked me about NST and gold, or let me just bring up NST. Sorry, I'll just move it here. So Northern Star Resources. Now, I don't know whether, Benny Boy, whether you own these or you don't own them, whether you're looking to buy them, but having a look at that monthly chart on the right on your screen right now, you can see it's starting to go a little bit more vertical, which is not too much to worry about at this point in time. If I just put a basic trend line on here, you can see the angles that it actually goes on. Now, if you've been watching these videos long enough, you'll see that when a stock starts to move more vertical, that means the mums and dads are getting into it and it'll run out of puff. And what happens is the smart people get in early, and the amateurs, or the unwise, I suppose nicely saying that, they get in towards the ends of the run. But when you start getting that sort of fourth pivot there, which we're doing there, 1, 2, 3, 4, it's starting to come to the end of the run. So I'm not saying it's going to happen right now. This current month, it's opened there at $9.24, had a $9.80 high, but it's come right back at this point in time at $9.47. So if I just expand that up, and the monthly chart really is critical and key to you understanding how far this will go. Now, yeah, gold if it does keep going up. Remember, gold's also affected by the Aussie US dollar and other different factors or metrics around that, because there's always a cause and effect. Why is something moving, or what's causing it to move? And then you look at that and you'll figure that out. Right now, I'd like to see if this thing's going to be continue to be bullish, then that close needs to be right up the top, because it hasn't, not a very big bar. And this is some of the stuff we teach about in our trading mentor course, our cheap beginners type of course. We talk about short-term bar analysis and how one bar relates to another one and what we're doing here. So, and really on this, I'd really need to see the close high this year before I get too excited. If you're in this stock right now, there's no reason why you shouldn't stay in the stock. That's not the issue I'm saying. If you're looking at taking a brand new position, the answer would be, from my point of view, no. You may see some more upside on this, but the risk is too high. You're better off getting another stock. Looking at that weekly chart, having a real quick look here, you can see here it's had 1 week down. A little bit of indecision last week, so it'll be interesting to see if it goes up this week. If it doesn't go up this week and starts to move down, then that downward move, it may be finding that resistance and starting to fall away. It may be about to start a downtrend. I'm not 100% sure, but it may be. The next stock I want to look at is Dulux, and Dulux was by Paul Hennessy. Thanks, Paul, for recommending a stock, so keep doing it, and anybody else who wants me to look at stocks, please do. Send them through. Always stick down below there and put your details in and say, hey, Dale, can you have a look at this stock for me? I also really love you to put in that what you're doing. Do you own it? Do you not own it? Why? If you want to buy it, why do you want to buy it? Because it starts helping me understand your psychology and what you're thinking and how you're processing things. And then I can address those during our recording. So, as I said, Paul Hennessy, thanks for bringing up Dulux. Interesting stock, this one. I'll have a quick look on the monthly chart. You can see it's all-time high, November 2007. It's a pretty well-known brand in Australia. It's had definitely a reasonable fall right down into December, but looking a little bit more bullish at this point in time. It's found some support around these sorts of levels. Where's my trend? Where's my horizontal line? Horizontal black line there. You can see how it's had this big sideways move right across this sort of area, somewhere around that 620-ish. So it's finding some support there. I'm not suggesting it'll start to rise. It may fall down to where my line is around that $6 mark. People tend to remember around round numbers like $6 in terms of support and resistance, and that's why I think support and resistance is my least preferred type of analysis, but it's actually most people that don't trade very well, it's one of their most preferred analysis is support and resistance. A lot better tools around to use, but at this point in time, Dulux is not proving to me it's going up, but it's not proving to me that it's stopped falling either. And looking at that weekly chart, let's just bring it up here. We can see a little bit of indecision. We've had a bar, very, very strong bar going up here on the weekly bar chart. The next one really gaps high and trades down low. Real lot of indecision. Next one opens where my pointer is, trades right back up, comes right back down onto its low. The market's not wanting this stock to go up, and it's really sharing to me that it's not super strong at this point in time. So I'd probably be more leaning to it's got more downside to go, maybe down to that $6 level at this point in time. Would I be buying it right now? No, I definitely wouldn't be buying it right now. I'd be expecting it probably more to fall further. And that's just like a pendulum, like, going this way, buy, or going this way, sell. Right now, we're sort of in that middle area where it's not a buy yet, but it's not, you should have already been out of it. If you actually own this stock, you shouldn't be in it. You should have been out, just some simple basic rules, you would have been out at around that $8 mark, in terms of $7-8 mark, and you'd be saving yourself a hell of a lot of time in a stock that's been falling away. So thanks, Paul. Got some stocks now from Bharat. Bharat gave me a whole lot of insurance stocks: QBE, Perpetual, IOOF, Platinum Asset Manager, and Challenger. All basically financial stocks, or Platinum Asset Management's not, but the rest are financial stocks. Sorry, Brad, I'm not going to be able to do all 5 of those for you today, but I'll do one of those for you today, or 2 of those for you today. I've done Northern Star, so let's get rid of that. Where's the next one here? I'll do QBE. QBE is one of these great stocks. I used to love trading this stock back in 2001, but it's been a really, really sort of strange stock since then. So you can see here, right through here. So that was September 11th, 2001. That was interesting thing on this. Back when I was actually flying to Perth that day and getting in a plane that day and watching it on the TV screens at the Qantas Club. But I was actually doing a workshop that weekend, and the week after as well. I had to go back to Perth. And people were saying to me, hey, well, you wouldn't have guessed the big drop of QBE after that. Your rules wouldn't have picked that up. Well, they did. And I showed them on the spot that just some of our simple rules that we teach in our course would have had you out of that stock nice and early. In fact, good big stocks always give you signals about getting out at the right time, and so you don't get caught in these big falls. Since this high way back in 2007, this stock has just been going south down to around that $10 mark. Now, $10 mark is a real super strong level for QBE. And as you can see there, if I just drag it out a bit, you'll see that $10 mark, and I'll just put my crosshair on it so you can see it. You can see that horizontal black line. That's around that $9.61, and you can see it's got down to about $9.19. But most of the trading happens between that $9 and $14-ish, or $15 mark. There's a lot of profit if you can capture some of that stock between $9 and $15. There's $6. So that's like 70% runs it does make, but you've got to capture those. And that stuff that's going to be, unless you're good at it, it's going to be a bit high risk, and you're going to miss a lot of those runs. So is QBE going down? No, I don't think it is. Is it going up? Not sure. But I'm not going to be convinced that QBE is going up until it starts breaking through this sort of $14 mark, and I'd stay right out of it until then, because you might just be a little bit in that another range again. That said, it's been doing that for 6 years in that sort of range. So, but eventually it will break out. But insurance companies tend to be a little bit like that, depending on, because tsunamis, and there's been a whole lot of different things going on that's affected QBE's stock price over the last decade or so. So right now, I'm not excited about QBE from that point of view. So let's move on for another one. IOOF Holdings again for Bharat. Thanks, Bharat, for putting these things. Again, put it down below if you want me to talk about a stock. Type the stock in there and why you want to talk about it and what you're doing about it, whether you own it or you don't own it. IOOF, it's been looking like a dog for quite a while now. It's been in the news more recently. ASIC's come in and pretty much sacked the board because they weren't doing the right thing. And you can see this huge, big move up the top here. It's all-time high, $11.57 in January 2007. And you can see this other high here at $11.46. So $11.46. And what's that one again? $11.57. So we're talking 11 cents difference between January 2007 and November 2017. So nearly 8 years in difference between those two highs. That's a huge, big double top. Big warning signal as soon as it starts coming down. So if anybody owned IOOF, you would have been getting out just pretty much on a double top warning. And you can see it's fallen very heavily, and obviously in December it took a really big hit in December, moving down, having a range of $3 on a stock that had it opened at $7. So that's a big hit. It's found a little bit of support here, but I still wouldn't get too excited about it at this point in time. We've had a few weeks up, but nothing major here. We had 1, 2, 3, 4 weeks up. Little indecision through here, and again, that's the sort of stuff we talk about in our trading mentor course, our beginners course. Only $14.97, dirt cheap. Especially when you get to email me your questions and I'm your mentor. So to me, right now, I wouldn't be in this stock. I wouldn't be looking to buy it. I'd stick it on my watch list a little bit, because if it does prove some strength through here, then I'd probably look at buying it. But that's pretty much all I would be doing from that point of view. And I think that was the last stock that I've got yeah, that's the last stock I've got for Australia now. So thanks, guys. Thanks, Bharat. Thanks, Paul. Thanks, what was the other gentleman's name? Benny Boy. Thanks very much, Benny Boy, for sending those stocks in. Again, put your names down on the bottom. Type some comments. Hit like. I need you to hit like on these videos. That helps everybody else find us as well. So put some comments on, hit some like, and subscribe to our channel to keep up to date. So see you next week.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on Soundcloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillam, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.